Hello everyone, my name is Blaine Pearson and I'm a graduate instructor in Texas Tech's Personal Financial Planning program. In this video, we're going to look at the earnings per share and the price to earnings ratio. To begin, let's first look at the earnings per share. You may also see it abbreviated as EPS. The earnings per share simply means the earnings or the profits after all the taxes have been paid. So what companies can then do is take these earnings and either use them to pay dividends or to reinvest back in the company. So we can take this earnings or net profit and divide it by the number of shares. That gives us our earnings per share. This number tells us for each individual share of stock, how much is that one individual share of stock earning. So if we see an earnings per share of $1.35, that means our one share of stock earned $1.35 in profits. Moving on, we could take a look at this graph. This graph is just a time series analysis beginning in the 1860s all the way to today. Here is on the y-axis the S&P 500 price index. As we can see, there is some correlation between the earnings of stocks and the price of them. Typically, when the earnings of a stock or a sector go up, the price also goes up. Moving on, the price to earnings ratio is a way to quantify that number and a ratio that makes all of the earnings on an even playing field. So simply the price to earnings ratio is the stock price, so the price that the stock is currently trading at, divided by this earnings per share number that we just learned about. For example, if GE stock is trading at $23 a share and has an earnings per share of $1.35, this gives us a P/E ratio of 17.04. The price to earnings ratio is a way that we can standardize the results of a company. For example, if GE stock were, let's say, worth $1,000 a share, how is that comparable for the same amount of earnings? This provides a way to systemically analyze stocks amongst other stocks. So, in thinking about that concept, a stock that has a low P/E ratio typically is an indication that it is a value stock, and there are few opportunities for growth. If a stock has a high P/E ratio, it may be a growth stock. Recently, there have been several articles and publications from Fama French and others that have looked at the value stock effect and how that has translated amongst various investment statistics like the P/E ratio, and how this correlates for the entire market. Moving on, if a company does not pay any dividends, the price to earnings ratio can be used to value its stock. So for example, as we get into various discount models and dividend models, the price to earnings ratio can be very helpful. Because the P/E is just how much an investor is willing to pay for each dollar of earnings, we can use this to compare. Low P/E, as mentioned before, may indicate a relatively good buy, but it's also important to compare P/Es within the same sector. For example, a low P/E in a tech stock may actually be a high P/E when compared to industrial stocks. Moving on, we can take a look at a few examples. Let's say ABC stock has earnings per share of $2 and a market price of $30. What is ABC's P/E ratio? We can calculate this by taking the market price per share and dividing it by the earnings. ABC stock has a P/E ratio of 15. XYZ stock has a market price of 40 and the P/E ratio is 15. Using some basic algebra, we can conclude that the earnings per share of XYZ stock is $2.67. And lastly, DQ has an earnings per share of $2 and the PE is 15. What is the stock price? Again, we can do some basic algebra and conclude that the price of the stock is 30 per share. Here's a chart that shows the PE ratio of the S&P 500 through time. This is the Shiller PE ratio chart. The Shiller PE is just the cyclically adjusted price to earnings ratio. Again, this is Blaine Pearson, and in this video, we covered the earnings per share and price to earnings ratio. Thank you for watching.